10 years. That's how long it's been since hedge funds dumped tech at this scale. Goldman Sachs just flagged it, and most retail investors have absolutely no idea what's coming next. Here's what's really going on and what you need to be thinking about right now. Goldman Sachs is sounding the alarm. Their prime brokerage desk, the team that tracks institutional money in real time, has just recorded the largest single hedge fund sell-off in tech stocks in a decade. We're not talking about a minor rebalance. This is a full-scale institutional exit. Smart money isn't trimming positions, they're walking out the door. The Nasdaq has been the engine of market returns for years. Right now, the biggest funds on Wall Street are pulling that engine apart, piece by piece. These are firms managing hundreds of billions of dollars. When they move, markets follow. And right now they are moving, fast and in one direction. Here's the gut punch for everyday investors. If you're sitting in a Nasdaq-heavy 401k or ETF portfolio, you may be on the wrong side of the biggest institutional trade of the decade. The last time hedge funds sold tech at this magnitude? The dot-com era. And we all remember how that ended. But here's what nobody is saying about this yet, and this is the part that should actually keep you up at night. This isn't panic selling. Goldman's data suggests this is deliberate, systematic rotation. These funds aren't running from the market, they're repositioning into something else, which means the money didn't disappear. It went somewhere. The question is, where? Energy? Defense? International markets? Whoever figures that out first is already 3 moves ahead. And here's the brutal truth about institutional rotation at this scale. By the time it hits the headlines, the first wave is already over. First consideration, audit your tech concentration right now. If more than 40% of your equity exposure is in mega-cap tech, you are carrying sector-specific risk that the smartest money on the planet just decided wasn't worth holding. Second consideration, study the rotation. Follow where institutional capital is flowing. Sector ETFs in energy, financials, and industrials have historically absorbed capital during tech risk-off cycles. That's not a tip, that's a pattern worth understanding. Third consideration, revisit your time horizon and risk tolerance. A 10-year high in institutional tech selling is a signal, not necessarily a death sentence for the sector. But ignoring a signal this loud is how retail investors end up holding the bag. The smart money just voted with their feet. What do you think this means for your portfolio? Is this the beginning of a major sector shift? Or are hedge funds making a massive mistake? Drop it below. This conversation matters. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.